Hey everyone, welcome to the KE Report in a daily editorial featuring Marc Chandler. Marc is a managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. I'll post a link to Marc's blog in the show notes. Marc, a lot for us to talk about as this whole week we waited for Powell at Jackson Hole and what he had to say. And quite frankly, I think we can take away from his speech that he was dovish, I guess, or more so locking in, not saying it specifically, but leaning towards that way of a rate cut coming at the next Fed meeting in September. The market was leaning that way, but we're seeing the reaction in the markets, in currency markets, that really are accepting that narrative now that a rate cut is coming. To me, I'm a little surprised at just how strong these markets are, but rate cuts seem to just be gasoline on a bull market fire for these markets as they corrected for about 5 to 6 days and now just shot right up on Friday. Marc, what do you take away from what Powell had to say at Jackson Hole?
Yeah, I agree with you. I think Powell sort of puts the nail in the issue. I think that essentially the market was leaning towards a rate cut in September. They had flirted with a 50 basis point rate cut, and I think that that had calmed down after the producer price index and the retail sales. But people I think went into this Powell's speech today, or speech on Friday, I should say, hawkish, looking for Powell to be somewhat hawkish. And to your point, the S&P 500 fell for 5 days in a row before Powell spoke. And I think Powell has indicated, I think clearly, I think to for many of us, confirming the rate cut is coming despite the firmer CPI and that jump in PPI. The focus is shifted. Many of us suspected the focus had shifted previously, but I think Powell's comments sort of drive home the message that the deterioration of the labor market is more important right now for Fed policy than the uptick in inflation. And I try to think about what kind of information set the Fed will have when it meets again in the middle of September. And of course, the next big report is going to be the non-farm payroll report in the US on September 5th. And the early call, so these are economists who are reporting into the Bloomberg survey, and the median is for 83,000 rise in non-farm payroll. That's after 73,000 previously. And it's not they even talk about the downward revisions, but it also means that the market is expecting the unemployment rate to tick up to 4.3%. And so the Fed is looking at the same things that we are, that are coming up with these economic forecasts. So they too must be seeing some more deterioration in the labor market.
Well, Mark, just to that point, I'm just going to read a quick statement that Powell made to the point you just made. He said that overall, while the labor market appears to be in balance, it's a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising, and if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. So it seems pretty clear there that they are worried about the downside in the labor market more than the concern about inflation. But there were a couple of dissenting members, even from that statement, like Bostic, that was more worried about, we don't think we have seen the full ramification of the tariffs yet. And what if the tariffs aren't just a one-time cost that gets, either absorbed by the companies or some of it gets passed along? What if we have more of a systemic inflation issue? So do you think there'll be a continued tug of war inside the Fed where there's the camp inflation and camp labor markets?
I don't think there's going to be, I mean, to your point, yes, the Fed has two mandates, and there does seem to be some differences at the Federal Reserve itself. But I don't think that they're really material. I mean, what I would suggest, though, is that at the last meeting, we had two governors dissent, and they dissented in favor of the rate cuts, attributing it to their assessment of the labor market. I think that at the September meeting, if there is a dissent, it'll come from a regional president, not a governor, and it'll be in favor of standing pat while the vast majority, vote in favor of a cut. I think that at the end of the day, Powell, like his predecessors, have done a fairly good job of keeping everybody together. Not of groupthink so much as a general consensus of what the best course of action is. And I think that it's going to become harder to your point, that inflation might not have peaked yet, while we're getting the deterioration of the labor market. So I think it's going to be hard, given those conflicting forces, to maintain this unanimity in decision making. It fissured before on the dovish side, and I think it could fissure again with a president, one regional president, voting in favor of standing pat, while the rest of the Fed is going to vote for a cut.
Do you really think that this is the start of a series of cuts, though? I think that's the most important thing. We've been expecting a rate cut for years now. We're finally going to get a couple more. It doesn't seem like it's going to be a 50 basis point one. But most importantly, will we see many more coming?
Well, I think that we should expect the September meeting, the Federal Reserve, to do three things. First, cut interest rates. Secondly, they give us a new dot plot, a new forecast, the macroeconomic forecast. The last one in June had the median looking at 3 rate cuts for next year. I think that'll go to 4 rate cuts in 2026. And the other thing the Fed will do will also drive home the more dovish message is that the Fed, as you know, is still engaged in quantitative tightening, which means that the Federal Reserve has a balance sheet. Some of the bonds are maturing, and rather than replace all the bonds that are maturing, it's letting some roll off. I think that with the reverse repo, which is where a lot of money markets park excess reserves, if you will, that the reverse repo levels, the usage is falling sharply. And this is telling me that reserves are reaching a level that'll get the Federal Reserve to slow down and have an exit strategy for QT. So the three things the Fed does are going to be pointing in a more dovish direction. A rate cut, more rate cuts next year, 4 instead of 3, and stopping or slowing QT.
Well, Mark, in this kind of environment, if we bring it over to the market reaction, obviously the markets like easy money. They like the idea of rate cuts. They like a dovish Fed. But is a lot of that at this point already factored into these blast higher and almost across the board in almost all asset classes? Or do you think there's enough fuel to keep the party going if there's a series of rate cuts? Because it seems like the forward-looking markets have been looking forward for a long time for this, and now it's here. Will there be a day crescendo afterwards?
I don't know. I mean, I think that in my mind, that the Fed began the easing cycle last year, and what slowed them down this year, if we take Powell at face value, is the tariffs. And now that we're getting more of the deals announced, this past week we got the U.S.-EU deal. Looks like it's solidified. I think that we have a better sense of what's happening, of how far the tariffs are going to go, even though we're still waiting for those sectoral tariffs. So I think that the Fed took what turns out to be about a 9-month pause in an easing cycle and is going to resume that. I think that the stock market initially, to your point, is driven by access to cheap capital. But if the Federal Reserve is not able to avert a deeper slowdown, I think that we're going to see the stock market sell off on weak economy. That is, weak earnings growth will be the ultimate driver. And even if in the short run we get this, we sort of get this sugar buzz, a fear of missing out, and lower interest rates driving equity prices higher. I do note, though, that today, you would think that with this more dovish Fed that Powell articulated or seemed to confirm, that it's interesting what's happening to the yield curve. The 2-year note yield fell 11 basis points or so. But the long end of the curve, the 10-year yield, only fell 7 basis points. That like flattening of the yield curve tells me the market is not so worried about inflation. If I or investors had been worried about inflation, I think we would have seen the yield curve steepen. And it's not. It's becoming less steep, some flattening after Powell spoke. And so I think that, and we're having another bout of it now, despite the White House's seemingly efforts to encroach on the Fed's independence, I don't think the market's buying it. I think the market partly has sold the dollar, partly in reaction to Powell, but also in reaction to President Trump's threat to fire Governor Cook if she does not resign. And that's really been the big development this week as far as the Fed goes, besides Powell's speech, was really this problem that Governor Cook may have, and it could lead to President Trump having another seat, another governor that he could appoint. We'll have to see how that plays out, but the markets aren't really buying it. They see through it. They think this is an encroachment on the Fed's independence, and it's just been another factor to weigh on the dollar.
Mark, could this all be setting up for a blow off top? The top that so many people have been looking for in these markets as they just seem to relentlessly go higher. But now with the Fed pivoting, with economic data broadly weakening, is it the perfect recipe for, yes, a move still higher, but that being the ultimate top, at least for longer than a couple months?
I don't know. I mean, I think that once again, I mean, I think people have been rewarded to buy the dip, to buy the pullback, like we saw in early April with the tariffs driving the stock market. People talking about like the end of days, and the stock markets come back, making new highs, and even this 6 day drop mentioned with the S&Ps. People are once again rewarded for buying the dip as we make new highs. And so I don't really know further than that's in my nose. I can't see much further ahead right now with the stock market. I do see, though, that people, including people like myself, have been rewarded time and time again to buy a serious sell-off in the stock market.
Well, Mark, you brought up the fall of the dollar. That's also fueling markets higher, commodities higher, cryptos higher. And you follow the currency markets very closely. When you look at a lot of the currency pairs, I'm sure that plays into it. But how much of this is the reaction to other currencies, and how much of this is domestic U.S. financial policy and Powell's speech and the Fed? Give us a breakdown on how you're looking at the greenback.
Yeah, I think that, I think economic theory says that you should be focused on interest rate differentials. But in my work, I find that the dollar and different dollar pairs are more sensitive to U.S. interest rates than they are to the differentials. That includes Japan, for example. Most recently, it's also included the euro. I think that you tell me the direction of U.S. interest rates, and I'll have a good idea of the dollar. But what makes it this time so interesting is that just as the Fed resumes its rate cuts, other major central banks, leaving aside the Bank of Japan, the other G10 central banks are getting close to the end of their easing cycle. They've been easing all year. And so whether there's one or two left, I can imagine that in the next, by the end of next year, there's much more scope for the Federal Reserve to cut than other central banks. And I think that's part of the broader narrative for a weaker dollar.
Mark, any targets for how low the dollar can go? Because hanging around 100 still is historically strong for the dollar. Yes, it's well off of its highs of almost 115 in 2022. But once we break where we are very close to breaking right now, where could the dollar fall to?
Well, I had thought earlier this year that 95 was a reasonable target for this year, and I think we're going to overshoot that. That means go well below there. I'm looking at 90, maybe the high 80s for the dollar index, but this is still, I want to say that this is still the early days of what I expect to be a multi-year dollar decline. The dollar is still very overvalued, and I know the valuation only really matters when we're at an extreme. And as we sit here, the dollar is, well, I should say, look at the euro, more than 50% undervalued, according to the OECD's model of purchasing power parity. It's a simple model. It's just like a rule of thumb. It just gives us a sense. The yen is almost as undervalued as the euro, followed by the Canadian dollar. And so I think that we're still in the early stages. And to me, the early stages of what could be, say, 5 to 10 year dollar down move. And the dollar index peaked in 2022. So we're not just at the beginning of it. We're well into what I expect to be this multi-year dollar decline, which before it's over, we might be able to even be down to as low as 80, if not lower.
Well, Mark, even if you think about the dollar going down to 90, much less in the 80s, isn't that somewhat inflationary for prices? Because it means that your dollar's buying less. And so for the average consumer, won't that pinch their consumer spending and their ability to participate in the economy?
I think that a couple of things. I think what you say could apply to other countries, but in the US, most of what we import is already invoiced in US dollars. I think that the tariffs are a bigger threat to the inflation and to the consumer's purchasing power than the dollar's fluctuations. On the margins, I'd say yes, you give my choice. Does a weaker dollar mean higher prices or lower prices? I'd say higher prices. But broadly, to that point too, it does ease financial conditions, which is the direction the Fed wants to take things. And remember that a central bank wants the currency to go in the same direction as monetary policy. And so I think that the stimulative effect of a weaker dollar helps blunt the impact of the inflationary implications in the short to medium term timeframes.
So, Mark, after we move through the next Fed meeting, which it does again seem like they're going to be cutting, who knows what comes out of the White House to shake the markets? But what could be the next catalyst for these markets? Could we very well shift away from all the craziness that comes out of Trump and his tweets on tariffs and whatever to more financial policies the way it used to be before this presidency?
I don't know. I think that, we'll be watching, we should expect in the coming weeks a couple of things I think that are going to be important for the capital markets. One is we should expect some court decisions about whether all these tariffs that Trump is using emergency powers for, whether they're really constitutional. We'll get a court ruling in a couple of weeks probably, and it'll probably be appealed up to the Supreme Court, and maybe they'll be expediting that case. So I think the legal status is important. Secondly, we should be expecting some more regional sectoral tariffs, pharmaceuticals, chips, and possibly even critical materials. And thirdly, I think that the question about the independence of the Fed, it seems to me that even though Powell's term as chair does not end until May of next year, that there's a lot of talk from the White House that they're going to nominate somebody much earlier on, almost have the shadow chair for a while. And my sense is after the past couple of days, I had thought that Governor Waller, would be most likely a likely candidate. I see he was popular on some of the betting websites as well. But I think that his speech this week, really defending the independence of central banks, means that he's not going to be trusted by the White House to take the job. So it leaves someone probably outside of the Fed, but that means that it'll probably be the seat that's already available, the Krieger who Stephen Moran is going to fill in for until her term ended in January. So I think that the Fed is still this wild card. And the White House still has several cards to play. And as I mentioned, this whole thing with Governor Cook now adds another wrinkle to the story.
All right, Mark, we'll wrap it up here. Interesting end to the week, and I guess a good end to the week since the markets just keep ripping higher. But again, this whole Fed going easy is also a mixed bag as inflation is higher. The labor market is weaker, and yeah, I guess they are focusing on the labor market. But even as Powell said, you get inflation heading higher, then people demand higher wages. But if the labor market is weak, then maybe they can't demand those higher wages. It's a real interesting scenario if you're really taking the big picture look at it. But you look just at markets, hey, it's a good day for markets, good day to end the week as we are closing in on the end of summer. Mark, as always, thank you for your time. You want to follow along with Mark and his writings on a daily basis, click that link in the show notes. Visit the Mark II Market website. Have a great rest of your weekend there, Mark. Thanks for your time.
Good luck to everybody.